Trendsetters, welcome to today's Grade 12 Accounting Show on companies' financial statements. We have selected highlights from lessons shown early in the term to help you revise and prepare for your June exams. You can download the notes for today's show from learnextra.co.za/live. Now it's time to get on with today's lesson. Please post your comments and questions on our Facebook page on facebook.com/learnextra or on Twitter @learnextra so we can help you with your revision.
Your cash flow statement, what does it do? What does it reflect? What's the purpose behind preparing the cash flow statement? Remember that the cash flow statement reflects the movement of cash. Okay, guys? We are talking about the movement of cash. In other words, when you are doing the cash flow statement, you have to think cash. Keep that at the back of your minds. And another important reason, obviously, the Companies Act stipulates that the cash flow statement must be part of the financial statements of a company. Now, obviously, you have already prepared some financial statements. You are au fait with the income statement. You are au fait with the balance sheet. And now we're coming to the cash flow statement. Remember, that in terms of the Companies Act, you also have to prepare a statement of changes in equity. But Tibogo, lucky for them, in terms of the grade 12 curriculum, they do not have to prepare the statement of changes in equity. All right, so what is examinable, guys? Income statement, balance sheet, and the cash flow statement. Now, you will notice that for the purposes of the curriculum, you only have to prepare the following. What is it? Your income statement, number 1. Number 2, your balance sheet. And number 3, your cash flow statement. Got it? Okay. Now, you've prepared the income statement. You're a boffin at the income statement. You've mastered it. You've prepared the balance sheet. You're a master at the balance sheet. And after you've been with Mindset Learn, definitely you're going to be a master of the cash flow statement as well. Now, as I said earlier on, what are the purposes or the reasons for doing the cash flow statement? Number 1, to determine the cash inflows for the financial period and their sources. In other words, where is the cash coming from? Remember, we talk about generating cash. We are talking about where does the cash come from? What are the sources of the cash? We will also look at the cash outflows. In other words, what was the cash spent on? Right? Remember, guys, we're talking moolah. What happened to the money? Where is it going to? Then, what were the net effect of the changes in the cash? So in other words, what we are saying is that if your bank has changed, what is the reason behind the change in that bank account? As you will see later on when we get into the lesson. Okay? It's part of the published financial statements. We've alluded to that already. To assess the liquidity of the company, to also look at capital development projects, how are they to be financed, and obviously, if we look at this, does the company generate sufficient cash from its operations to maintain its current operating capacity? So those are just the reasons behind the preparation of the cash flow statement. Who will use these cash flow statements? Certainly management, your directors, your banks, and obviously your investors and your potential investors. Now, let us get into the preparation of the cash flow statement. And if you look at this diagram here, you will find that your cash flow statement has three basic categories, or it has three sections to it, which you need to master. Number one, your cash flows from operating activities. Number two, your cash flows from investing activities. And number three, your cash flows from financing activities. So already you can see that we are breaking this up into three categories within the cash flow statement. Now, obviously, what's the most common source of cash for any company? It deals with the buying and selling of inventory, receipts from our debtors, payments to our creditors, and the paying of expenses and the receiving of income. So that would fall under, now look at the inflows. Let's look at that so it makes more sense to you. What are we talking about here? When we are talking about the operating activities, right? Tibogo, I'm sure when you did accounting at matric level, you also looked at the cash flow and you said, maybe a bit difficult, but I'm sure once you understand the concepts, it becomes very easy to relate to.
True.
Okay, so what are my inflows? Monies received from sales, money received from other incomes, for example, rent income. Outflows, money is paid for stock, you purchase stock, money paid for expenses, money paid for tax, and money paid for your dividends. So all of that, grade 12s, the accounting boffins that are out there, falls under the category of my operating activities. So you can see that you have a clear guideline that when I'm looking at operations, what does it entail? What we have just discussed, that's where the categories, that would fall under the category of my operating activities. Okay, moving on to investing activities. When I look at my investing activities, what am I looking at? Where's my focus? Where's my goal? Where am I looking? What is it that I need to know? Remember, it's the changes in cash as a result of buying and selling of tangible assets, one. In other words, the changes in your fixed assets. And two, the changes in your financial assets, namely your fixed deposits. So let's look at the possible inflows. What do we have here? We have monies received from the sale of assets, and as well as any fixed deposits that are maturing. Remember, when a fixed deposit matures, we have an inflow of cash. What about my outflows? Money paid for replacing tangible or fixed assets. If I buy fixed assets, definitely money is going to leave my business. And money paid for buying new assets, obviously. I now look at the third category, namely the financing activities. And where do I place my emphasis? Or on what concept do I hone in? Watch. Number one, your changes in cash as a result of financing, that means the selling of shares, the issuing of shares, and also your non-current liabilities. So here you can see, what are my inflows? My inflows would be, if I sell shares, then obviously my bank account is increasing, and therefore we have monies received from the issuing of shares. Number two, monies received from obtaining a loan. In other words, if my non-current liability increases in value, what does it mean? It means that I took a loan, and as a result, my bank account will increase. So those are my inflows. What about my outflows? Watch here. Any monies that are used to pay for the repayment of loans. So guys, clearly when you are doing the cash flow statement, you will notice that under operating activities, when we're looking at the operating activities, You got to understand and you got to make sure that these are the operations of a business or a company, and these are specific items that you will be looking at. When you're looking at investing, again, you are focused. Focused on what? On tangible assets and your financial assets. So when it's investing, that's where I pay attention to. And thirdly, when I look at financing, what do I look at? I look at my ordinary share capital, I look at my ordinary share premium, and I look at my non-current liability. So this that we've done now, Tibogo, is basically your overview of the cash flow statement.
Okay guys, I hope you're enjoying this revision session. If you are struggling and need help, remember to post on the page or send an email to helpdesk@learnextra.co.za. Now it's time for a break, so don't go away. We'll be right back. Welcome back guys. I hope you are getting into the idea of revision. Please let us know how you are doing. I'd love to chat to you on the page or on Twitter. Enough of the chat. Let's get back to revision now.
Now let's start with the actual adjustments. And the very first adjustment that we've got, or additional information. The company has an authorized share capital of 2 million shares with a par value of 2 Rand each. Now remember guys, you are not completing any notes, and because you are not completing any notes, the first bit of this information, authorized share capital, is not really necessary. But what you do, however, need is that par value of 2 Rand. So for now, let's just circle it. I know we're going to need that info. Let's now look at information number 3. The following adjustments still must be considered. The first adjustment that we've got, the directors declared a final dividend of 10 cents per share on the 28th of Feb 2010. Okay, now remember, we're doing an appropriation account and we need ordinary share dividends. Ordinary share dividends, guys, is made up of interim plus final. So this adjustment is going to assist us to calculate what is that final dividend. Now, in order for me to calculate final dividend, I need, let's just extend the page there, I need number of shares issued. Okay, and I'm going to times my number of shares issued by each shareholder gets 10 cents per share. So let's start off with the calculation of number of shares issued. And this is where that par value of 2 Rand is going to come into play. So if I go further up, I've got the information that is given to me at the top, ordinary share capital, 1,150,000. So remember guys, this is the Rand value of shares. In order for me to calculate the number of shares issued, I am going to take my Rand value, 1,750,000, and I'm going to divide this by par value of 2 Rand. So let's get our calculator out and let's do exactly that. 1,750,000. Okay, and I'm going to divide that by 2 Rand to get number of shares issued, which is 875,000. So let's go back to our calculation. Okay, so number of shares that were issued, 875,000. And I'm going to multiply this by 10 cents in order to calculate that final dividend. So there's that 875,000 times 10 cents, which should be 87,500. So that is my final dividend. Okay, so final dividend, 87,500, guys. Just make that a bit bigger. Okay, should be fine. 87,500. And remember, this amount is my final dividend. Okay, let's now look at which two accounts are going to be affected with this final dividend that is declared. Remember, final dividend is never paid, it's only being declared. So the two accounts that will be affected would be my ordinary share dividends as well as shareholders for dividends. Okay, ordinary share dividend is the amount that I take to appropriation. Shareholders for dividends is a liability, so obviously it's going to affect my balance sheet as well. So let's now slot that in. Let's go back to the answer sheet. So appropriation account, there's my interim, but I now have my final dividend. So I'm going to add to this amount, let's just get that out, plus 87,500, guys. Okay, and then to my balance sheet, which is on the next page, just find that quickly. Okay, trade and other payables, shareholders for dividends, that is where I'm going to slot in also the 87,500. Okay, right, done with the first bit of adjustment. Let's now look at the next adjustment. Okay, the next adjustment, let's just take out this calculation quickly because we're going to need a bit of space there. Right, guys, the next adjustment. The assessment received from SARS reflects income tax of 103,200 for the financial year. In other words, we now have our tax assessment from the receiver, and they are now telling us that your tax expense for the year is this amount of 103,200. Right, now guys, very, very important, looking at this account. Okay, I'm just going to quickly draw up a T account for SARS income tax. Okay, we've been given, firstly, how much we should be paying the receiver. So according to this information, and I know you guys are absolutely familiar with this account, we're owing the receiver 103,200, but we now need to look at how much have we already paid the receiver. In other words, did we make any provisional payments during the year? Okay, so let's quickly scroll up to the general ledger and let's look for SARS income tax. Right, there we go. There's our SARS income tax. So a debit balance means we've paid the receiver thus far an amount of 95,000. So let's take that total to this T account and let's check whether we're still owing the receiver in terms of tax. Right, this is how much we should be paying. This is how much we've already paid the receiver. So clearly, if you inspect the two amounts, we still need to pay the receiver a balance of 103,200 minus 95,000. In other words, if I balance this account, guys, I'm going to end up with a credit balance. I am still owing the receiver. I should be paying the receiver 103,200. I have only paid 95,000, which means, let's just move that calculator. Okay, which means I still need to pay the receiver. Let's do the calculation, 103,200. Okay, and I need to subtract 95, just delete that, 95,000. And I still owe the receiver 8,200. Now the word still owing, guys, clearly it is a liability. So let's take that through to our balance sheet. I'm just going to write down the total. We're still owing the receiver an amount of, just see what the amount was. It was 8,000. Okay, 8,200. And remember, it is a credit balance. Okay, so let's take that through to our balance sheet. Okay, so in our balance sheet, under current liabilities, trade and other payables, I'm now adding on the balance that I still owe the receiver, 8,200. Right, let's go back to that information. And let's look at whether we need to take that information through to the appropriation account. Remember, we are also completing the appropriation account. So according to this information, I've been given my income tax expense for the year. And remember, in your appropriation account, on the debit side, you need to show this expense for taxation. So let's go back to our answer sheet, but this time to appropriation. Okay, on the debit side of this account, guys, my details will be income tax. And this time, remember, it is not what you owing the receiver, but rather the expense for taxation for the year, which was the amount of 103,200. Okay.
I have one question. It's from Tsepiso Koshimkwena. It says, guys, please rephrase the SARS T account. I don't get it when you say it's a credit balance.
A credit balance. Okay, no problem. Let's go through the SARS T account one more time. Okay, let's just bring this down a bit so we can focus. Right, SARS income tax account, guys. If you look at this ledger account, something that I always tell my students to assume. Let's assume SARS is a liability minus on the debit side plus on the credit side. Now, the information that we have been given, you've been told that for the year, provisional payments for SARS is 95,000. Now, where am I getting this information from? Let's go through that one more time. Okay, in this general ledger, the balances given to me on the 28th of Feb 2010, and if we look at this information, SARS income tax, there's my SARS income tax, a debit balance. Debit represents payments that were made to SARS, an amount of 95,000. So that 95,000 is obviously on the debit side of this T account because it represents a payment. Remember, payments reduces your liability. I am also told in the adjustment itself, the assessment received from SARS reflects income tax of 103,200 for the financial year. In other words, at the end of the year, the receiver of revenue has now sent the business its tax assessment, and the tax that the business should be paying is this amount of 103,200. Okay, now if we look at, this is how much we should pay the receiver, this is how much we have already paid the receiver. So remember, if I compare, guys, if I compare what I should pay against what I've already paid, you can clearly see that I am still owing the receiver. In this case, if I subtract, I am still owing the receiver 8,200. Still owing means SARS is a liability. Under current liabilities, you owing the receiver again 8,200. I hope I've answered the question for her.
Now it's time for a break, so don't go away. We'll be right back. Welcome back from the break. I know you can't wait for the term to end and the July holidays to start. And of course, that means winter school. This year, we will be bringing you special exam revision sessions from the 1st till the 5th of July from 9 a.m. in the morning till 7 p.m. at night. We'll also be repeating the programs from 9:30 p.m. every evening. So don't miss out. If you want to do exam revision with other learners and get help from expert tutors, you can register for our winter school classes at a PC training center near you. Just go to our website www.learnextra.co.za/classes to get all the details. But for now, let's get back to revision. Over to you.
Okay, guys, we're going to look at firstly liquidity. Now, what do we mean by the term liquidity? This is very, very important, and it's a very common exam question. Liquidity is simply the ability, let's get this pen out again. Liquidity is the ability of the company to pay its short-term debts. Now, what do we mean by short-term debts, guys? Here we're talking about all their current liabilities. So can the business pay their current debt, their current liability, such as their creditors, maybe they have a bank overdraft, maybe a short-term loan, their current liability. Now, the specific ratios that affect liquidity are your current ratio, then we have the asset test ratio, your debtors collection period. This ratio looks at how long your debtors are taking to pay their debts. Your creditors payment period. Okay. Then we have our stock turnover rate. Right, and then the last one, which you guys cannot see at the moment, and I'm trying to figure out, oh, there we go. Let's just go down a bit there. The number of days stock on hand. So your liquidity ratios, guys, remember, in an exam question, you must be able to identify your liquidity ratios. If you asked to comment only on liquidity, these are your 6 very, very important liquidity ratios. Right, let's now look at the next category. The next category is the category or the term solvency. Now, again, what do we mean by solvency? And again, guys, just like liquidity, this is a common exam question. Solvency is simply the ability to pay off total liabilities or total debts after selling total assets. In other words, whereas liquidity was looking at simply whether the business can pay short-term debts, solvency focuses on total debts. Now, the common mistake, AB, that we find in the exams, and I want you to remind your mindsetters about this, our mindsetters about this, is the students make a mistake. When we ask them, what is solvency? They say, okay, liquidity is the ability to pay current debt. So solvency is the ability to pay long-term debt. That's a common mistake that they make. But remember, solvency is total. Total means, can I pay current and plus my long-term liabilities as well? Current plus your non-current liability. Right, under your solvency ratio, guys, there's only one ratio, and here we're comparing total assets is to total liabilities. Let's move on. The next set of ratios that I'm going to explain, also absolutely important, deals with risk. In this category, there are 2 very important ratios, and here we're going to look at borrowing capital, so taking out a loan, versus using own capital. Own capital, remember, when you deal with companies, it's obviously obtained by selling of shares. So here, risk, looking at whether the company should borrow additional capital or should the company use their own capital. All right, let's pay attention to, or let's go through the 2 ratios involving risk. Let's talk about them in a bit more detail. The first ratio is your debt equity ratio. Debt referring specifically to your non-current liability. Equity referring to your shareholders' equity. Okay, another way of looking at it, debt refers to your borrowed capital. Equity refers to your own capital. So this ratio looks at borrowed capital against own capital. The actual calculation involves the following. So we're simply going to take our non-current liabilities, which we're going to obtain from the balance sheet, and we're going to compare this against shareholders' equity. Now, grade 12's very, very important. We've done a balance sheet. Shareholders' equity, please remember, refers to 3 components: ordinary share capital plus share premium plus retained income. Okay, you guys got that? absolutely important, because sometimes in the exam, they might not give you shareholders' equity, which means you need to remember, I need to add these 3 amounts in order for me to get my shareholders' equity. Now, also, when we're looking at this ratio, another term that you may have already come across at school is the concept of gearing. AB, when we talk about gearing, we're not talking about cars.
Yeah, top gearing.
No, definitely not. But here, in accounting, when we refer to gearing, we're simply establishing, is the business low geared? Low geared means low risk. Or is the business high geared? High geared would be high risk. Now remember, a company would strive to be low risk at all times. Yes, there are certain exceptions, but that's what a company would strive to be. You rather have your own capital instead of borrowing capital, because you have to pay interest.
Where do we draw those exceptions?
Okay, the exceptions, it's a bit tricky. Most of your textbooks would say low geared is anything that is less than 1:1. So for example, 0.5:1 would be considered to be low geared, because for every 1 rand of own capital, you have 50 cents of borrowed capital. Okay? High geared, on the other hand, would be anything more than 1:1. Where if it's more than 1:1, let's say, for example, my own capital is 1 rand compared to my borrowed capital, which is 1 rand 10 cents. Okay, but this gets a bit tricky, because sometimes, even though you may be low geared, by taking out an additional loan, you can become high geared.
Nice.
And that's what the question often tests.
Interesting.
Okay, right, let's move on. Okay, still with the category of risk, guys, the next ratio that we're looking at is your return on total capital employed. Now let's look at firstly the calculation itself. Here I'm going to need my net profit before tax, which I get from my income statement. Remember, here you are analyzing financial statements. So you're going to get your information from your income statement, or from your balance sheet, or from your cash flow statement at times. So net profit before tax is my income statement. To this, I'm then going to add interest expense, which I get from, let's just fix that, interest expense, which I get from also my income statement. And I'm then going to divide this by average capital employed. Now, guys, the word average, and I know you've come across this before in grade 11 and grade 10, average is simply the half of current year plus the previous year. Now, which amounts are we actually looking for in this ratio? Capital employed. The word capital employed refers to your non-current liability plus shareholders' equity. In other words, total capital that you have employed for the business itself would be what you've borrowed, as well as what the shareholders have contributed to the business. Okay, now when it comes to this ratio, guys, very quickly, very, very important. Return means, what do I get out of this investment? So if, for example, you are getting a return of, let's assume, 20%, we then need to compare this return to the interest that we are paying on the loan. So if, for example, the interest is 12%, this return is considered to be good for the business, because the return is much higher than the interest that is being paid. But if it was the other way around, so if, for example, our return was only 12%, but let's assume our interest, and I know interest cannot be 20%, let's hope that never happens, but let's assume the interest is 20%, then immediately as a comment, you know that my interest that I'm paying on my loan is 20%, I'm only getting out 12%, so this loan is actually not worth it. It's not worth me taking out this loan. I'm paying far too much interest in comparison to my return. Okay, right. let's look at the next category, guys. Very, very important, the category of returns. Here we're looking at 5 ratios in total. Shareholders, remember, when we talk about returns, returns affect your shareholders. Shareholders are your investors in the company. It also impacts on your potential shareholders, people who want to invest in your company. So they are very interested in these 5 ratios. Shareholders want these ratios to be as high as possible. So when you are comparing current year to previous year, you need to remember that. This ratio needs to be as high as possible. The higher the ratio, the more they want to invest in the company, the more they want to buy in the company. Right, let's just go down there a bit. Are we down? Yeah, we are. To extend the page. You may have to sometimes distinguish between a long-term shareholder as well as a short-term shareholder. Now, what do we mean by this? Long-term shareholder, I want to keep my investment for as long as possible, longer than a year. I want my investment to grow. A short-term shareholder, on the other hand, I want to keep my investment for maybe 3 months, 4 months, and I want to sell this investment the moment I see there's a possibility of me making a profit if I sell my shares.
Okay guys, I hope you're enjoying this revision session. If you are struggling and need help, remember to post on the page or send an email to helpdesk@learnextra.co.za. Now it's time for a break, so don't go away. We'll be right back. Welcome back, Mindsetters. Today we are doing revision. Even though we are selecting highlights from previous shows, you can still follow me on Twitter @LearnExtra or post or comment on our Facebook page, facebook.com/LearnExtra. Right now, let's do some more revision.
Guys, the question that I'm going to do today was taken from November 2009. End of the year exam, and it was question 5. So even if I don't finish, you know that's a question that I was looking at, November 2005. The information given was, let's start again. The information given below was extracted from the financial statements of Manchester Limited, distributors of exquisite perfumes. And then we've got our required, but before we look at the required, I think let's go through the information first, because it's on a separate slide. So this is the information that has been given to us. We've got an extract of the income statement given to us, guys. Then there is the balance sheet, and looking at this balance sheet, it's a completed balance sheet that is given to us. Okay, and then on the next page, we then have some additional information as well. Okay, so we've got some additional information, right, all the way down through. Looking at the additional information, I notice they've given me earnings per share. They've given me total dividends. So this is my dividends per share that they've also given me. They've broken it down into interim and final, and then at the bottom, they've got, you are provided with certain or the following financial indicators: percentage return on shareholders' equity, return on capital employed, and then my net asset value per share. Okay, right, and then there's a last bit of information here, which I'm going to read. The price of the shares on the Johannesburg Security Exchange, or the JSE, has fluctuated meaning it's obviously going up and down, between 680 cents and 780 cents over the past year. Okay, so we've looked at the information, and before I go to the actual question, guys, something absolutely important, and I know a lot of you watch Ashraf and he's mentioned this, is please, very, very important, 2009, 2008, 2009 is my current year. 2008 would be my previous year. Absolutely important that you don't mix the two. Right, let's now look at our questions, and we'll obviously come back to that information. The first question wants me to calculate the following for 2009. So in other words, for the current year. Okay, very important that you read the question, you could read the entire question. The first is your current ratio. Now, current ratio, guys, I know you remember this. You've been doing this from grade 10. Current ratio, I'm looking at current assets is to current liability. And where am I going to get this info from? Correct, from the balance sheet. So let's go to the balance sheet. And remember, we're looking for current. So my current assets, okay, let's get the pen out. There's my current assets. And I know I'm going to need my current liabilities. At the bottom, there is my current liabilities. So no calculation, taking it from the balance sheet. So one more time, current assets, current liabilities. So let's fill that in. So my current assets was an amount of 320,000, and your current liabilities was a total of 390,885. Okay. Right, when you're doing ratios, remember, I want the right-hand side to equal to 1, so I'm going to divide by 390,885. Whatever I do on the right-hand side, I must do on the left-hand side, so divide by 390,885. And here, obviously, we're going to get a ratio of 1. Let's get the calculator out. Clear that. Okay, so we get taking 320,000, and we are dividing this by 390,885 to get a ratio of 0,8. Remember, guys, round off to the first decimal. 0,8 is to 1. So let's fill that in. 0,8 is to 1. Okay. Now, the question doesn't want you to comment, only wants you to calculate. But if you had to comment, guys, for every 1 rand of current liability I owe, I only have 80 cents of assets to pay, current assets. The next ratio, remember we're busy with November 2009, sorry. The next one is your asset test ratio. Just change that, asset test ratio. And the ratio itself, I'm going to take my current assets minus stock or minus inventory is to or compared to my current liability. Now already, guys, from the information or from the previous question, I know my current liability is that amount at the top, which is 390,885. My current assets, which was 320,000, I've got to now pick up my inventory amount from the balance sheet, so let's do that. Okay, so let's get rid of the calculator. Right, my inventory, that's what we're looking for, so inventory under current assets. So there's my inventory, and my inventory, quite a large amount. Okay, 251,250. So let's take that. Okay, wrong slide. There we go. So we're going to subtract that inventory amount that I've just read out. 251,250. Okay, let's make the writing a bit smaller there. Right, let's now work out this ratio. So remember, this calculation needs to be done first. So let's get the calculator out again. Okay, so I'm taking 320,000, which is my current assets, and I'm subtracting my inventory 251,250, which is, oh, what did I do here? Let's do that one more time. 320,000, and then minus 251 250. Okay, that looks better. 68,750. So 68,750. Remember, guys, the word asset test ratio without your stock. Can you still pay your current liabilities compared to 390,885? So again, guys, we're going to divide by 390,885. Whatever we do on the left-hand side, we do on the opposite or the right-hand side as well. So 390,885. And here I'm getting 1. Let's get the calculator out again. Okay, so I've got that figure already, divided by 390,885, and I'm getting a ratio of 0.17, or if we round off, 0.2 is to 1. Okay, so 0.2 is to 1. So immediately, again, you don't have to comment, but if we did have to comment, can you see this business is obviously struggling with liquidity? They're struggling to pay their short-term debt. How do we know that? Because for every 1 rand of debt that is owed, they only have 20 cents without their stock in order to pay this debt. So clear indication of liquidity problems. Right, the next calculation, guys, are your net asset value per share. So let's look at the formula. Ordinary shareholders' equity divided by number of shares issued. Okay, let's just bring that up a bit. Right, ordinary shareholders' equity, I'm going to pick that from my balance sheet. So if I go to my balance sheet, I'm looking for equity. Okay, so there's my equity. My ordinary shareholders' equity, remember, guys, is a sum of these 3 items. So ordinary share capital, share premium, retained income. So if I add up these amounts, the total at the top is my ordinary shareholders' equity, 3,120,000. So let's take that through, 3,120,000. I'm now going to divide this by number of shares issued. Now remember, I mentioned this. How do I get number of shares issued? So in order to get number of shares issued, I'm going to take my ordinary share capital. I'm going to then divide this by my par value to see the actual number of shares issued. And I'm just going to write here, this is always at the end of the financial year. So let's go back to our balance sheet. My ordinary share capital is given to me. Let's just quickly get a different color pen. So that's my ordinary share capital, and the amount 2,085,000. And I also need par value, which is given to me as well. Par value is 5 rand. So by taking my ordinary share capital divided by 5 rand, or divided by 5 rand, I'm going to get the number of shares issued. So let's do that. Okay, so we've got 2,085,000. I'm going to divide this by 5 rand to get number of shares that are issued, 417,000. So let's take that through. Okay, 417,000. And remember, guys, I think I want my answer in cents, so I'm going to multiply by 100 to get my answer in cents. And again, the calculator out. We are taking 312, okay, and watch those zeros, quite a number of zeros, divided by number of shares. And my net asset value is, if I'm going to multiply by 100, okay, is 748.2 cents. So let's write that down. Is 748.2 cents, or if you wanted to show your answer in rands, 7.48 rand. Okay, right, guys, let's move on to the next ratio. Your debt equity ratio. And remember, I spoke about this, guys. Sometimes they call this the gearing ratio. Your debt equity ratio, we're obviously going to be looking at your non-current liability compared to your ordinary shareholders' equity. Debt equity. Remember, don't swap them around. Okay, ordinary shareholders' equity, we've already used that figure, and that was the figure above, the 3,120,000. That was your total shareholders' equity. Your non-current liabilities. Let's go to that balance sheet and find our non-current liabilities. There we go. There's our non-current liabilities, and it's sitting at 300,000. So not bad compared to our, if I compare that to our equity, but let's do the ratio itself, 300,000. And again, guys, whenever you're doing ratio analysis, remember, you want the right-hand side to equal to 1. So I'm going to obviously then divide again by 312,000. And then whatever I do on the right-hand side, I obviously do on the left-hand side as well, 3,120,000. And we're now ready to work out what is that debt equity ratio. Okay, calculators out. Okay, 300,000. Okay, divided by 312. And again, lots of zeros. And that gives me 0,09, or if I round off, 0,1. Okay. Right. Abraham, quick question for you.
Yes.
Okay, look at this ratio. I've got a ratio of, this is my equity, my own capital is 1 rand, and my borrowed capital is 10 cents. So am I low geared or high geared?
You're low geared.
Oh, low geared, fantastic. Okay, now I definitely need to bring chocolates for you next week.
Thank you.
We've come to the end of today's show. Thanks for joining me and for chatting to me during the show. Don't forget to include Learn Extra Winter School in your plans for July. Go to our website, learnextra.co.za/live to get all the details. Also remember that if you are stuck on any questions, you can get help by sending an email to helpdesk@learnextra.co.za. All the best for your exams.